bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 10th, 2025 episode. My guest this week is Dirk Wallace. Dirk's a partner in Novogradac's Dover, Ohio office. As the one big, beautiful bill makes its way through Congress, many in the affordable housing, community development, and renewable energy areas are wondering how the various legislative changes will affect the supply and the ability of investors to use federal income tax credits. Now, regarding usage, I'll note that the House bill contains what's being referred to as a super BEAT provision. And this super BEAT provision could drive some U.S. corporations that are subsidiaries of foreign corps to quickly exit the tax credit investing market. Now, I'm not going to go into what super BEAT is and why that's the case, but it's just an example as to how the various provisions in the one big, beautiful bill that would affect the supply and usage of tax credits. Now, as we await the Senate and its passage of its version of the one big, beautiful bill, my partner, Dirk Wallace, and I thought this week would be a good time to discuss ways which Congress could increase the demand for community development tax credits. Now, obviously, increasing demand would create upward pressure on tax credit equity pricing. And doing that would generate greater levels of affordable housing, community development, and renewable energy development from whatever the existing level of tax credits are. I'll also note that today's podcast is an offshoot of something that I do explore more deeply in my Washington Wire column in this month's, that's June's, Journal of Tax Credit magazine. I will include a link to that column in today's show notes. Now, my column discusses changes Congress could make that would increase the demand for existing tax credits. Now, for today's podcast, Dirk and I have selected 4 of the points in my column that would increase the demand for tax credits. Now, the 4 that we suggested or that we're going to talk about do not actually change the stream of tax benefits. Rather, they increase the pool of investors as well as improve the assurance that an investor will get the benefit that they bargained for. More specifically, the 4 areas we're going to cover today are 1, allowing investors to exceed a 75% limit to reduce their tax liability. And Dirk will explain what I mean when I say that. 2nd, we'll discuss expanding the allowable carryback period for tax credits, community development tax credits in particular, to 5 years. 3rd, we'll discuss the benefits of removing the passive activity limits for community development tax credits. And 4th, we'll discuss the benefits of allowing the new markets tax credit to offset the alternative minimum tax. We have a lot to discuss, so if you're ready, let's get started. Dirk, welcome back to Tax Credit Tuesday.
Thanks, Mike. Glad to be back.
Good to have you back. In case you're counting, this is your 14th appearance on Tax Credit Tuesday, including one just about a year ago where you were the host. And that was an episode, as I know you will recall, in our So You Want to Be a LIHTC Developer series. And the episode covered the stages of development for affordable and low-income housing tax credit housing. I'll also note for our audience, we do have a playlist of all the episodes in that series on YouTube. And I will include a link in today's show notes to that episode. With all that said, Dirk, I'm sure there are some members of our audience who haven't seen one of your previous 14 appearances. So for them, please describe some of the services that you provide to your Novogradac clients.
Sure. So I work primarily with affordable housing developers, loan housing tax credit syndicators, doing audit and tax work, as well as cost certifications in several states. Do various consulting engagements as my clients need consulting on various due diligence items. We help out with consulting engagements. When I'm not an accountant, I lead our loan housing tax credit working group, and that working group addresses regulatory and legislative issues. Some of those we'll be talking about today. So please check that out if you'd like to become a member.
And let me also thank you as part of your work with the Local Tax Credit Working Group on your efforts with our Chief Public Policy Officer, Peter Lawrence, to estimate the amount of additional unit financing that we'll get from various LIHTC changes. I know that's a labor of love for you. It happens during busy season. Maybe it's much more of a labor that you love it and you less.
Well, it's always great to see how the various provisions kind of interact with each other. And coming up with those estimates is a good analysis to do. Definitely.
And I should also note to our audience, not only do we have the 4 that we're going to talk about, there's also a bonus topic that we have at the end. So of the 4, the first that I'd mentioned said in a way that only an accountant could love. And I talked about allowing community development business tax credits to reduce tax liability beyond the 75% limit, which implies there is a 75% limit.
That's right.
So with that said, if you could level set for our audience what I'm referring to there and why being able to exceed the 75% limit would be positive and increase demand for community development tax credits.
Sure. And I think a lot of our listeners would like to think that just the community development tax credits are the ones that are subject to this limit, but really it's general business credits. And there's a lot of general business credits, not just a loan costing tax credit or a market tax credit. There's more than 30 general business credits that taxpayers can receive to offset their tax liability. As the question kind of implies, there are limitations within the Internal Revenue Code on the amount of those tax that those general business credits can offset. And when you work through the calculation, it results in taxpayers generally being able to offset 75% of their tax liability. So if a corporation is estimating their taxes and the taxes that they might be paying in a given year, then their appetite for tax credits wouldn't be that full estimate. We would apply 75% limitation to that. And then I imagine corporations are putting in some type of buffer then, even within that 75%, just to make sure that they would be able to use the tax credits whenever they are received, and they wouldn't lose any time value of money play because they would have to carry forward those credits. So really removing that limit would allow investors to look at their full tax liability. And these are large numbers. We're not talking about $1 million, $2 million. We're talking about hundreds of millions, if not billions of dollars. And 25% of that is a large number. And opening that up and allowing these tax credits to offset the full liability would certainly increase their appetite, which should increase or create some upward pressure on tax credit pricing because of that demand increase.
Thank you for that. And just to add on, there are investors that we know of that are getting close to that 75% limit, which does end up impacting their ability to use these tax credits, which affects their ability to invest in them. And not only is it something that they look at over the next year, if you're investing in a stream of tax credits, like long-living tax credits for 10 years, you have to know that you're going to be above that limit over the next 10 years. And knowing that you cycle through a recession or something else, you're still within that limit. And if community development tax credits didn't have that limit, they could go all the way to zero, then it would mean that various investors could look at it with a lot more comfort when they're investing in development tax credits. As a consequence, there would be a increased desire for many existing corporations to invest, which, as you know, would drive up repricing. Mm-hmm. And mentioning the fact that if you're investing in a stream of credits like the long-living tax credit over 10 years or renewable energy production tax credits, or even the historic tax credit over 5 years, or the new market tax credit over 7, there is this notion that over the next 5 to 10 years, I need to know that I have adequate tax liability. And I have to be able to think about what a recession would do to my ability to use those tax credits. The next recommendation helps ameliorate some of those concerns. And that has to do with creating a 5-year carryback period for community development tax credits. So if you could share for our audience, I know you can, please share for our audience what the current carryback period is for most community development tax credits, as well as what the benefit of a longer carryback period is?
Trading. Well, yeah, I think to kind of start with, we've been talking about the estimates and when corporations estimate their future tax liability, again, that is an ever-changing estimate, year over year. And I think that the good thing about being able to have a carryback is that is a known number. You look at a 2-year carryback, a 5-year carryback, 3-year carryback, they can look at what their tax liability is within those years and say, okay, we can increase our appetite, maybe not even have a buffer because we know what our actual liability was. There have been times during, I think we mentioned the recession, where certain tax credits were allowed to be carried back longer than they are now. And currently, the loan causing tax credit doesn't have a carryback, but it's a 20-year carry forward. So we're looking at the ability to carry forward a tax credit, which again, you lose that time value of money, where carrying back the tax credit would give you kind of that immediate benefit because you could carry it back as soon as it's claimed. So I think that's one thing that would be very attractive for investors, because if their estimates don't come in as underwritten, which if no estimate's perfect, you're not going to get down to the dollar, finally find out what your tax liability is, you could then immediately carry those tax credits back and offset that. So I think this would create a lot more immediate demand, especially a 5-year carryback in year one, because it now opens up 5 years tax liability, where if you just did 2 years or 3 years, it wouldn't create that big of a immediate impact. So I think this could create a lot of upward pressure, just knowing that 5 years of tax liability is available to be offset.
Thank you for that. And I would just also emphasize the fact that as you're looking into the future, having this kind of rolling 5-year period allows fluctuations in taxable income to not have as damaging an impact on your potential use of the credits in the future, which gives you more confidence that you'll get a current benefit. Because you mentioned that you do have the ability to carry it forward, but when carried forward, you don't get nearly the time value of money benefit
Right.
from it. You get to record it for book purposes. So you do get book earnings. And definitely there are some companies that will invest purely for the book earnings, but they get the economic cash benefit. You do want to be able to carry it back. So that's something I would just want to emphasize for our audience. So let's move beyond the carryback period and move to something that we're hearing more and more attention placed on. And that has to do with the passive activity limits contained in Section 469. And to level set for our audience a bit, back in 1986, the Congress was concerned about rental activities being invested in by individuals, wherein they were gaining tax benefits, and as a consequence, driving more capital into certain rental activities. That those rental activities include equipment leasing, residential rental development, and a number of other sort of activities. And more broadly, folks were investing in businesses in which they didn't materially participate, but they were generating these tax losses. And those tax losses were driving capital in areas that Congress thought were getting too much capital. And I talk about this a little bit more in my Washington Wire column. But what Congress did is said, if you don't materially participate in activity, you can't claim those losses against activities that you do materially participate in, like your salary, or if you're a doctor or a dentist from your medical practice. Plus, they said all rental activities are per se passive. As a consequence, if you invested in a rental activity like residential rental, like any type of equipment leasing, those losses could only be offset against, as a general matter, against income from similar types of activities. And they did, though, Congress did look at that and say, we're going to create a carve out for long-term tax credits and historic tax credits, albeit it was a small carve out. And that small carve out drove the investor market for low-income tax credits for a number of years until around 1993, when several other changes came into play that really led to corporations dominating the market, and which was a good thing because it drove up equity pricing. So with that as background, please explain what the benefit would be if the passive activity rules were removed for investments in community development tax credits.
Right. And I think it's all about expanding the investor pool, because right now, as you mentioned, if an individual receives a W-2 and that W-2 is not passive income, so the ability to use tax credits to offset that passive income, you can only use it to offset passive losses. So by removing that limitation, you're really opening it up to 330 million individuals, primarily focused more maybe on net worth individuals or those with a large tax liability. But really, there's just a large investor base that really isn't able to tap into the loan causing tax credit because of these passive activity restrictions. I think you mentioned the one exception for rental real estate professionals, and there's a whole host of requirements to meet that definition. So really for your, say, attorneys, dentists, doctors, some that may have a desire to invest in these credits, they're really limited by their ability to increase in investment beyond the passive activity limitations. So it's really about, just opening up broadening the investor base, creating more investors. You have more investors, you have more demand that provides upward pressure on equity pricing. So it's really the main benefit there.
Yeah, definitely think opening up the investor market to family offices be pretty dramatic in terms of the increase in the demand, and as a consequence, the increased equity pricing, which, as I've noted earlier, would build more affordable housing, create more soil preservation, community development, as well as renewable energy from existing resources. And I'm working on a column for the next edition of the Journal of Tax Credits, where I actually dig down a little bit more on this individual angle. And I myself was surprised that individuals pay 4.5-fold of what corporations pay in annual federal income taxes. So 4.5 times. But guess what percentage of community tax credits they claim? Less than 5%. It's quite remarkable, the disparity. And when you look at one notable community development incentive, opportunity zones, because it's open to individuals, 2/3 of the investors are individuals. So opportunity zones is proving how valuable it is to open up the market to individuals. So it does seem like it's just a matter of time, not a question of if, but when passive activity limits get adjusted so more individuals can invest in the local tax credit, more can invest in the historic tax credit, more can invest in various renewable energy tax credits, which would be sort of a classic win-win-win situation. But you'll notice, when I mentioned the various community development tax credits, some of our more acute listeners will be thinking to themselves, well, Mike, you didn't mention new markets tax credit. Why didn't you mention new markets? Was that just an oversight? It was not an oversight. Consciously didn't mention new markets tax credits because the way in which the new market tax credit is generated means it is not considered it's not limited by the passive activity rules. So then you're probably thinking, well, then why are more individuals investing in new markets tax credit? And there's this quirky result where these other various tax credits can't be claimed by individuals, but I should say, as a general matter, can't be claimed by individuals. But if they can be claimed, they do offset the alternative minimum tax, whereas the new markets tax credit doesn't. So please expand on that and what the central request here would be.
Yeah, the request would be to allow the new market tax credit to offset that alternative minimum tax or that AMT for individuals. As you mentioned, other credits currently do allow it, like the loan housing tax credit and the historic rehabilitation tax credits. So it's more to kind of level the playing field with those other credits that are already allowed to offset AMT. But it's interesting when you say level the playing field, because those credits are passive credits. So it's a different playing field almost. It's
Yes.
kind of, so what we're talking about today kind of levels all the playing fields. If we would, if it would allow historics and LIHTC to be to offset or to not subject to passive income requirements, and then allow new markets to offset AMT, now all of a sudden, all three tax credits that we've been talking about would kind of have the same restrictions or have lack of those restrictions. So really, I think allowing that to happen, again, you're expanding the investor base, because the individuals, if they're taking a large amount of tax credits, that alternative minimum tax is going to kick in. It's different for everybody, but chances are a large amount of tax credits will trigger AMT. And then so now instead of paying your regular tax liability, you're paying your alternative tax liability. And now you have all these credits you have to carry forward because you can't use. So just for removing that, an individual could have a clear picture of their tax liability, knowing that even if AMT kicks in, that they can use that to offset. And it really just opens up to that pool of investors you talked about, like opportunity zones. So I think the consensus is there are investors, or there are individuals out there that would be willing to invest in these community development tax credits, and just giving them the ability to do that would really create a lot of upward pressure on pricing for all the community development credits.
And as you know, Dirk, and many of our listeners who frequently download the podcast and listen or watch it, know we're working with a number of groups to try to create a separate provision that allows nonprofits to syndicate tax losses to individuals and use those proceeds to renovate and preserve affordable housing. And one of the pushbacks we've gotten is that, and that provision is designed to just be marketed to individuals, not to corporations. And one of the pushbacks we've gotten is the 86 Tax Reform Act is somewhat sacrosanct with respect to the passive activity rules. And to create a carve out for a very targeted area isn't something that Congress would want to do. And as part of that, we always have to remind people that, and I was there in 86, that the 86 Act did create a carve out for legacy tax credits and historic tax credits. So it's not like there isn't a carve out there already for congressionally sanctioned activities. And all that we're really talking about is expanding that carve out.
Mm-hmm.
I also like to remind folks that back in 1993, there was a number of folks that recognized that the 86 Act went too far in limiting the ability to deduct losses for rental activities. And there was one real estate developer who really helped lead the charge to expanding and creating an additional carve out of these rules. And once again, many of our listeners already know who I'm talking about. He's now president of the United States. And he recognized how damaging the passive activities rules were for real estate more generally, and certainly within the residential rental market, pretty devastating, as I document in my column that I'm working on now. So I do think that it's a bit of a heavy lift to get past these passive activity rules, but I think carve-outs exist now, and all that we really would be asking for is sort of expanded carve-outs of the passive activity rules. And then I would note with respect to the ability to offset the AMT, if the new market tax credit can offset the AMT, I think you would really quickly see a large number of family offices invest. And that might be a way, like almost like a trial case of taking a particular tax incentive, marketing it to family offices and others, and really democratizing community development tax credits, and as a consequence, driving up the equity pricing. So I mentioned in the intro part that there was going to be a bonus topic. And the bonus topic is bonus depreciation. And I say that because the one big beautiful bill does include a going back to bonus depreciation, and that going back to bonus depreciation would affect the timing of benefits in terms of accelerating the stream of tax benefits, which should help in terms of equity pricing. Please explain to our audience what bonus depreciation is, because it's really not bonus depreciation. It's not extra depreciation. But if you can explain what it is and why it would be meaningful for many investors.
So bonus depreciation is sometimes referred to as 100% expensing as well. And the reason it's referred to as that is because it allows you to immediately expense 100% of fixed assets with certain lives, appreciable lives. In the case of a loan causing tax credit property, there's typically three types of fixed assets. You have your building, which is over 27 and a half years or 30 years depreciated. You have your site improvements and you have your personal property. And the site improvements and the personal property, those are the two asset classes in which bonus depreciation would be allowable. So currently, bonus depreciation is phasing down. It used to be 100% and it continued to phase down now at 20% a year. Bumping it back up to 100% would accelerate those benefits and allow taxpayers to immediately expense their 5-year and 15-year property in their loan causing tax credit properties. Now, one key, effective date for the bonus depreciation is going to be a written binding contract. And the effective date is January 20th of 2025. And if you had a written binding contract in effect to purchase the 5 or 15-year property before January 20th, then that would not be subject to the 100% expensing of bonus depreciation. And you might say, January 20th, why January 20th? That seems like a very odd date. Well, so typically what Congress will do is when they introduce a bill, they'll create an effective date as of the date in which a bill is introduced. So they essentially don't want taxpayers to receive a benefit that they otherwise would have done. And so they created this. So they introduced the bill January 20th, and that becomes then the effective date for any written binding contract written or entered into thereafter would be subject to 100% bonus depreciation levels.
And you might also wonder, what else happened on January 20th? There was a certain president that gave his who took the oath of office.
Mm-hmm.
So I think Donald Trump was very focused on it being effective as of the date that he took office. And I would note that Chairman Mike Crapo of the Senate Finance Committee many, many months ago had talked about the full expensing being retroactive to January 1 of 2025. So I have been waiting to see if the House bill January 20th date stays in the Senate bill, or if the Senate bill kind of goes back. Somebody tells me it'll probably stay as the 20th, given that was the date of President Trump's inauguration, but we'll have to wait and see. And then, as you noted, it's most meaningful for the loan causing tax credit, where you'll have personal property and land improvements that could be expensed. So that's valuable in terms of accelerating the tax benefits. Renewable energy tax credit property, that can be obviously valuable because you can expense those assets. It's less valuable for the historic tax credits and new market tax credit for a variety of reasons that we're happy to discuss.
And also note that the Tax Cuts and Jobs Act had a similar provision where it increased the bonus depreciation. And I believe in that written binding contract language was in that bill as well. I believe the effective date for that was September 27th, I believe. But that was another one where there's a clear cutoff. It's not usually a year end or something of that nature. It's usually tied to a specific date.
So thank you, Dirk. If anyone in our audience has questions for Dirk, I will include his contact information in the show notes. Dirk, what are the resources beyond calling you, which should be the first resource, do you recommend for our audience who want to learn more about some of these topics?
The LIHTC Working Group is a great resource. The working group meets once a month to discuss what's going on in Washington, as well as industry issues as far as what developers, investors, attorneys, syndicators are facing within the industry. So we have a good group of folks that meet once a month, and we would love for everyone to be a part of that. So please reach out if you are interested in a working group. And we also have our Affordable Housing Tax Credit Conference coming up in Nashville. That is September 25th and 26th. And that'll be a great conference, again, where a lot of industry leaders are come together in Nashville. A lot of great networking events, and should be a lot of things to talk about in September.
Yeah, I would like to emphasize the long-term tax credit working group. Please do join. It's a great way to stay current on various long-term tax credit issues, as well as to help influence regulatory and other policy. So it's something that I think is really valuable. Encourage everyone in our audience who works in affordable housing to become a member, and organizations become members, not individual. So once your organization's a member, all the various folks within your organization can participate. And then with respect to the Affordable Housing Conference in September in Nashville, super hopeful, fingers crossed, that we'll be discussing the lowering of the 50% test, the additional 12.5% allocation of 9% credits. And we'll be talking about the native lands and rural bonus, 30% basis boost, and the impact that'll have. And then we'll be discussing the implementation, what we're seeing at the state levels, and all of the rest. So it should be quite a conference to be working through the implications of the House tax bill on the affordable housing community. So Dirk will also link to those items in today's show notes. And in a moment, we'll jump to our off-mic section. But let me first take this opportunity to encourage all of our listeners and all of those who are viewing the podcast on YouTube to subscribe to the podcast on whichever platforms you get your podcast. And for those in our audience who are watching on YouTube, I encourage you to like and comment on the video. That helps raise our visibility and helps others in various tax credit communities identify our podcast. I also encourage our audience to share the podcast with colleagues. It's a great way for them to get started on a variety of topics. Obviously, the local tax credit, new markets tax credit, and the other tax credits in which we work. And it's particularly good for those who are newer to the space to maybe even binge watch some episodes in order to get a little bit more up to speed. And as our regular listeners know, all of these podcasts are available on our website at novoco.com. Okay, Dirk, let's turn to the off-mic section where we get to give a shout out, or I should say my guest gets to give a shout out to everyone working in the tax credit community to highlight our professionals who deserve recognition. Dirk, who would you like to shout out?
I would like to give a shout out to Tracy Townsend and the accounting group with National Equity Funds. We work with them a lot throughout the year, and May 30th was a big investor deadline, and we're all working hard to get through that deadline. So shout out to Tracy and her group.
Great. Let me echo that shout out, and I'll give a shout out to their leader, Matt Ryline, and their strong advocate in Washington, DC, and Matt Joseph. So thank you, Dirk. Thank you for being on the podcast today.
Hey, thanks, Mike.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.